Gentlemen, we don't have the World Series title in our hands, but pretty fun little run there we had to enjoy. Sadly, didn't go our way.
We haven't had a major title in our hands in Canada for what, 32 years now?
Well, no, no. The Raptors won.
Oh, sorry, the Raptors.
Oh,
Yeah, I was looking at baseball. You're right, but I was looking at baseball and hockey. I forgot about the Raptors.
the poor Toronto fans, hey.
Who would have thought baseball brings the country together? Of all things.
Well, maybe Carney can bring us together on a budget this week. I think that's coming out by the time this goes to press. We're going to know a little bit more about our liberal friends out in Ottawa.
I'm curious how you think a budget can bring us all together these days, Craig.
It's my cautiously optimistic hat that I have on right now.
Yeah, lots going on. Let's get right into it. Gold is on everyone's mind right now. It seems like that's all anyone wants to talk about. Obviously, we've seen gold hit an all-time high. What was it, $4,500 an ounce before retreating a little bit. What do we make of this? What should investors and our clients be thinking about the surge in gold prices?
Well, maybe I'll tackle that. Certainly, Jay, I think that's very topical. We've heard a lot about that over the past couple of months, and I'm going to say on the theme or the term bubbles. You turn on any sort of business commentary right now, news channels, and that's the topic du jour. And whether we're in a bubble or not remains to be seen. I think what you've seen, maybe we can talk about technology or even just gold. I think what you've got likely is some short-term euphoria that's driving the price of some of these sectors or commodities or specific names, probably to valuations or to price levels that maybe allows us to take a pause here and just kind of reevaluate where things are at. But yeah, I think it's just a function again of what's happened so far in 2025, a lot of mistrust and I think hesitancy with respect to asset prices in general. And here we are at the beginning of November, and equity markets are within, as of today, within 1% or if not at an all-time high. And same with a lot of commodities and overall asset prices. So kind of in the theme of 2025 is expect the unexpected, in my opinion.
With gold, Craig, I mean, generally gold is a safe haven.
Yeah.
And, we see gold, people rush into gold when there's something going wrong in the world. And that usually coupled with equity market weakness, US dollar strength, kind of a flight to safety trade. It happens. I always tell people that, gold is cyclical. It's a trading vehicle. It rallies once every 7 or 8 years and then doesn't do anything for the next 6 or 7. And I'm not smart enough to pick the one out of every 7 or 8 years that it's going to be a good trade. So we just kind of avoid it. Now, this time seems a little bit different because you have what is traditionally a safe haven asset, breaking out to new highs, rallying as it is when everything else is doing well as well. The US equity markets are at all-time high. The US dollar is weakening rather than strengthening, from a flight to safety trade. So it just seems like something a little different is going on with gold right now, rather than just kind of a flight to safety, cyclical trade.
Well, maybe let's talk about that. I think we know that, one of the largest buyers of gold right now are foreign governments and central banks. I think the Chinese continue to be huge consumers of gold bullion themselves. And I think that's a function, again, of de-dollarization or gaining exposure outside of US currency. And 2025, the US dollar relative to most other global currencies has seen depreciation. I think that's a big part of it, de-dollarization, as I said. And I think you also see, as you said, this flight to safety amongst the general retail crowd. And that feeds upon itself. And you see that with the fund flows into the gold sector in general.
Yeah, I think that a lot of it has to do with that, which is a de-dollarization trade, concern about US budget deficits, US debt in general. I think maybe you don't want to say this time is different, but again, it feels a little bit more like a repositioning, maybe a longer term repositioning by central banks, as opposed to just kind of a retail driven, fear trade or flight to safety.
The point you made there about gold being cyclical is just so important to remember. And for all of our clients that are and people in general that want to participate in whatever is working today. I think it's just really important to understand that the cycle will have the other side, the other side of the cycle will start to unfold at some point. I don't know if it's going to be this year or next year or when, but gold will go out of favor just as it's in favor right now. And for investors, I think you really need to be careful investing in what's on the front page of the newspaper or what's, currently in favor. And I think that's something that our clients really need to keep in mind. AI is kind of the secondary bubble that continues to get a lot of press. All the investment being made by some of the big kind of tech companies and kind of the infrastructure needed um, to help AI continue to develop, whether it be Amazon, Microsoft, Google, you name it. It seems like every company, not just the tech companies, even are really making massive investments in AI, and the profit that's associated with those investments isn't clear, as we've touched on in the past episodes. Where are we at with that current quote unquote bubble?
I think first of all, Jay, you have to differentiate between, is the theme a bubble or are the stocks a bubble? And, we can see, or we've seen over the last few decades, a lot of themes that, the theme itself became bubbles. Like you think about cannabis, is that everybody in Canada thought that that's going to significantly increase the demand for cannabis. The whole theme went through the roof, as did the stocks. This time around, I think if we look at this as a bubble, AI itself is not a bubble. It's a real thing that is transforming every industry out there, or will. The demand for cloud computing, the demand for energy to drive AI, the demand for chips from companies like NVIDIA, it's real and it's transformational, and it's going to change the way that we do things going forward. So I think it's real. And I think, again, we have to differentiate that and then look at what's going on with the stocks behind that. And, when you see valuations get ahead of themselves, like the amount of capital that's flowing into that area, it's questionable whether the profits that come from AI will ever outpace that. That's where my concern would be. And the other thing that generally, typify or, shows a bubble is when you have so much money chasing such a concentrated number of names, it just generally doesn't end well.
But those are the names that have been showing leadership now for a number of years. Yes, you can throw 2022 into there. And, when you saw a lot of these names down 50, 60, 70%, yeah, you can make the valuation argument on that. At the end of the day, all asset prices were down in that highly inflationary environment. Where we sit today, that's a lot different in, I would say, that a contained inflationary environment, interest rates coming down, that in a declining interest rate environment, that supports multiple expansion and the demand for names such as this that are trading at a premium in a lot of people's minds. But if you look at the earnings growth that we just saw last week coming out of a number of these names, they're exceptional. You had Amazon beat by 20%. You had Microsoft come in above 40%. You had Google come in and announce $100 billion quarter. The numbers that actually is transpiring out of these companies, I'd argue that the market is willing to pay up for that earnings growth potential. And
yeah, I think we might have that wrong a little bit, is that I think what the market does, it looks at the growth that we're seeing today, which is remarkable, and extrapolates that too far into the future at too high of a pace. And, we've talked about this before, but if you look back to the .com era, could make the same argument today that we're making with NVIDIA and Broadcom and these AI chip producers, as we would have Lucent, Nortel, Cisco, the hardware manufacturers during the .com boom. The .com boom was real. It was revolutionary. It changed the way that we did things. But that demand was heavy for a few years. And then as things started to slow down, that demand went completely out of the room. And, two of those three companies went bankrupt. I'm not suggesting that here. And Cisco fell 90% and went sideways for 15 years before it got back to where it started from. So I think, we can talk about valuations and, hey, maybe they make sense because the earnings growth and low inflation, low interest rates. But at the end of the day, these companies have to remain profitable, remain with that high degree of earnings growth to justify a lot of these valuations.
Yeah, I mean, I think at some point you're going to run into a situation where it's just there's all of this money is going into, AI in one form or another, and growth rates are going to moderate. And it's not a matter of if, but when. And I think as an investor, you really just need to be mindful of that. So it's tricky because as portfolio managers, we want to participate in these themes that are doing really well, obviously, and see prices go higher. But we also want to just be mindful of the other side of these themes, because as they do play out and inevitably run out of steam, that's where money starts to get allocated elsewhere and the next theme starts to emerge. So one of the kind of themes that was on everyone's mind for the last 15, 20 years, particularly here in Vancouver and in Canada more generally, was the real estate theme. And so we had everyone wanting to be a participant in real estate as prices continued to rise, as prices became detached from a lot of the kind of traditional metrics that you look at, whether it's income to value ratios and all that sort of thing. And everyone could justify it by immigration was going to support prices, or limited amounts of land was going to support prices. And now we are in a situation here in Canada where real estate has really traded down for the last 6 months, and sideways at best for significantly longer than that. The Globe and Mail had an article citing Nicola Wealth, local investment dealer that recently restricted client redemptions on some of their real estate pools, kind of showing you the other side of these themes running out of gas and what can kind of come of that. But any thoughts on kind of the current status of Nicola Wealth situation, and maybe more broadly, kind of less liquid investments and kind of how that can affect investor assets?
Yeah, why don't we talk about? I'd like to circle back though, and again, we've talked about this. I'm going to go back to this bubble thing and a couple comments. We can all sit here and try to hypothesize when a bubble is, what the capex. I think we all have extremely valid points. I think what this is more reflection of is ensuring that you have that investment strategy in place to manage as things change. If you see a position, whether that be a Microsoft, an Nvidia, a gold stock that is showing leadership start to deteriorate, well, you have to have a process in place to hopefully recognize that. You're not going to pick the top, you're not going to pick the bottom, but have that process in place to say, hey, you know what, maybe it's time to lighten up a position and reallocate that cash. I think that's a far better approach than anybody, whether it's us or anybody that you listen to, saying Nvidia's overpriced. Because if that was the argument, well, that would have kept somebody out of the stock for the past 3, 4 years. And I'd argue that amongst a lot of leading stocks right now. So again, we can all try to guess, which it really is at this point, if this is a bubble and when it does pop, have a process in place to manage that. And I think you're going to get a far better outcome than waking up and saying, I'm going to sell my position in Amazon.
Well, I'd add to that, Craig, is diversification is probably the most
There you
important
go.
way
Yeah.
to manage that risk. You don't have to pick the bottom or pick the top. You can ride some of these things down 30 or 40% if we do go through a tech-related correction. But if that's all you have in your portfolio, you've got a problem. And as we've all talked about for years, the sector diversification kind of keeps you out of some of those problems.
Yeah. Jay, with your comments on private equity, private credit, we get asked that, and I think you're exactly right. We've probably seen that more over the past 12, 24 months as interest rates have come down. There's this penchant to kind of go out and seek for yield. And you've seen that amongst, private credit, for example, that maybe illiquid mortgages or access to real estate, whether that's here in Canada, North America. And it all sounds extremely sexy until you run into an issue, what we've seen more recently, when a lot of these funds just essentially close out, or what we refer to as gating those funds, and investors don't have access or any liquidity whatsoever to get their money out. That's a major problem when they run into this, because that just feeds upon itself. Because the next time they open up the gates for a liquidity event, everybody rushes to the front of the line to get their money out. So I think it's all due diligence of looking under the surface of why someone wants access to private equity or private credit and what their exposure is in their portfolio. Because when these red flags pop up, they can present a lot of challenges.
And I think the thing to add to that, Craig, is, why are they gaining redemptions? Why is there a liquidity problem? And it's the underlying asset, which, just to explain that a little bit, they invest in illiquid assets. It's not like one of these funds owns shares of Microsoft or Nvidia or Royal Bank or whatever it might be. They own private real estate. They own private mortgages. They own private equity, meaning shares in companies that are not publicly traded on a market. And when everybody wants to run to the exit and they cannot sell those investments, there's no cash there for these redemptions. That's the big thing. I think you mentioned kind of the chase to yield. And I think the caution is anytime that, there's a marketing campaign out there by a company promoting these products with an above market yield, like a lot of these real estate funds and mortgage funds were promoting 8, 9, 10, 11, 12% yields. And people tend in good times to forget about the liquidity risk. And I think anytime you see a yield that outpaces kind of market yields that much, what is that premium on the yield? A lot of people kind of see that as the free lunch yield, and it's not. It's the yield that you're receiving for that lack of liquidity. And it's fine if things are going well, but as we're starting to see here, when things don't go well, that's when that cost of liquidity starts to creep up.
Look at the ads that we're playing on the Blue Jays games, or pretty much everywhere on TV right now. It's advertisements for funds that are, again, very illiquid, whether it's a mortgage fund or a debt fund or a private equity fund. And our industry does a really good job advertising to people with this whole idea that you can earn a higher rate of return and take less risk. Reality is, time and time again, this just proves to be false. It's just, you find the right environment, and clients are expecting to get their money back or expecting to earn some sort of yield, and that can change really quickly. So always buyer beware with all of these types of investments that are either thematic when it comes to things that are attractive right now, or providing you that higher return with lower risk, or access to a market that wasn't accessible before, is kind of a very popular way for some of these capital aggregators to market themselves. So yeah, another story that we've seen before, but unfortunately won't be the last time either.
Well, the sum of the parts is again, I think investment strategy at times gets overcomplicated, and we probably feel at times, maybe our clients, that we take a pretty vanilla approach, but that's for a reason. After 20 plus years working together, we've realized that some of the pitfalls are these stories that we hear, and whether it's liquidity, whether if it's yield, whether if it's, something that's perceived as high risk or off book. Again, it's the snake you don't see that bites you. And I don't think there's a last snake that we're going to hear about over the next number of years here.
No, and I think, Craig, when you said these are kind of sexy investments and how Jay mentioned how they're marketed, and I'd agree, you say our industry does a great job at marketing these things. I would say our industry does a terrible job at marketing these things in the wrong way. When you're telling people, like, you give people that impression of the free lunch, and you say, this will give you access to institutional type investing, low correlation to markets. You get your equity like returns plus, and bond like or GIC risk. Like, what part of that should somebody take a step back and says, it seems too good to be true? And again, when everything's going well, it is too good to be true in a sense. It's great, but when things start to slow down as they are, that risk that people don't really understand and are not being honestly promoted in a lot of these cases, comes home to roost.
Yep. Well said. Yep. Buyer beware.
Buyer beware. So switching gears a little bit, so a lot happening politically, geopolitically. We've had kind of the war in Gaza, wind down for the most part. We've had the government in the US shut down for almost a month. I think it's the second longest government shutdown ever. We've had a number of things happening on the trade front. It seems like every other day we've got tariffs going up or down, depending on the country, with the US. All of these kind of geopolitical events that are net negative for the global economy, I would say, to some degree. Well, in the case of the war in Gaza, obviously that hopefully is positive, but these things are just not impacting the markets. So how do we kind of tell clients that, or how do we explain to clients, to kind of discard your political beliefs and stay invested through all of these fairly significant issues, going back even to Liberation Day, which obviously created a little bit of a correction in the market, but since then has been largely ignored. So what's the strategy there for clients as we're looking at an ever-changing world?
Well, I'll challenge you a little bit on that. I think when you say kind of surprising that markets haven't really reacted to this stuff, is I think the markets are doing what it should and looking, below or beyond the headlines and looking at things that really drive the market, whether it's liquidity, whether it's fundamentals. And what was going on in the Middle East, I mean, it's terrible, but at the end of the day, what would be the biggest risk coming out of a Middle East conflict? It would be a significant rise in oil prices. A closing of the strait didn't happen. So oil prices remain muted, didn't affect the global economy. If you look at the government shutdown, I mean, this stuff is political theater that happens every, 18 to 24 months. We see it almost every time now. Government gets back to work, people start to get paid. And at the end of the day, really, what effect has it had on the economy? So I think, again, the market's probably, in this case, doing what it should be doing and being smart and kind of looking beyond the headlines. Whereas I think a lot of people are out there just looking at the headlines and saying, as you started this piece, Jay, why aren't markets correcting here? I think that's a simple answer for it.
The takeaway really is, and we've said this time and time again here and elsewhere, it's the market doesn't care about politics as much as we all tend to. The market is going to focus on earnings. The market is going to focus on, corporate profitability. And despite, substantial amount of chaos out there in the world, companies are going to go about their business and try to sell more products and services that next year than this year and put plans in place to do so. And as investors, we've really got to kind of put our blinders on and focus on that and focus less on what politicians are promising us, which is tougher and tougher to do, as you noted earlier, Clark, with the election in New York City, potentially paving the way for some significant change there in one of the most important commercial hubs in the world. So it'll be interesting to see how that all kind of shakes out.
Yeah, I mean, headlines create a lot of noise and they often create a lot of volatility. And I think, what truly creates wealth over time is having discipline, kind of ignoring a lot of those headlines, having a process, basing your decisions on fundamentals, not emotion, not headlines. And I think that's what a lot of people get too wrong, is they want to follow headlines and make short-term emotional decisions.
Well, think about if someone tried to make investment decisions over the past 6, 7, 8 months with the political noise that we've had through tariffs, through, as you said, some of these geopolitical events, Russia, Ukraine, what have you. If that was driving your investment strategy, you would be whipsawed left, right, and center trying to get in and get out of the markets. And I'm going to tell you right now, that's a fool's game to try to do that. I think there's an old saying, there's old traders and there's bold traders, but there's never old and bold traders. It doesn't work that way. And I think your point is extremely well taken, Clark, that the market does an extremely good job of filtering out all of this noise and finding clarity of what's actually driving asset prices. That's lower interest rates off of Bank of Canada and the central bank cutting rates last week. That's earnings that 84% of earnings expectations are coming in, above expectations. So that's our job. That's what I hope the smarter money looks at, is what's happening with the positions that you own, and ultimately, how is that being reflected in price action? And here we are, as I said 20 minutes ago on this call, beginning in November, and you've got equity markets at all-time highs. No one really wants to believe it. 80% of professional money managers are underperforming their index, and sentiment is generally still pretty shaky right now. I wouldn't be surprised that, yeah, you're going to get some volatility. That's part and parcel to an equity market cycle. But between now and year end, I think there's probably some good performance to be had, not only because people are underperforming to some extent, but there's tax considerations of selling a position right now and maybe pushing that out into the new year. That's something that we do on an ongoing basis. So fundamentally, I again, I don't need to paint it all with a rosy brush here, but despite what a lot of people think, there's probably more good than bad happening out there.
Yeah, Craig, you just mentioned something I was going to address. You said you don't need to paint everything with a rosy brush, but I agree with you. But I think that it's kind of what we're doing. I think it's not forgotten though that we do go through corrections.
Absolutely.
Fundamentals will weaken at some point. The economy is going to slow down, markets correct, and life goes on and things recover. So, I would agree that the underlying fundamentals right now are, I think, more positive. They're stronger than what the headlines, seem to indicate to people. But at some point, those fundamentals are weak, and that's what will, drive a correction.
So last little topic here on the day, fairly big news out of the province of BC, recently awarding a fairly significant chunk of land out in Richmond to the Cowichan First Nations. Without getting into our opinions or political beliefs on this matter, what does this mean for the BC economy? What impact might this have on business here in BC? And how can we think about this?
I haven't followed the story all that closely. Jay, when you say awarded a big piece of land, any more details on that? Where's the land located? Was it agreed upon, or is it still amongst the courts here?
I mean, I'm sure it's going to be in court for a long time, but
Right.
basically now there's a challenge where the First Nations have Aboriginal title on the same land that private owners have fee simple title, like the rest of BC landowners. And so there's competing title claims on land that is either lived on, there's housing out there, or there's most of it is on commercial land. Amazon has like 100,000 square foot warehouse that's sitting on land that they leased, but the owner of that lease now has a dispute of whether they actually own the land or not. It's come out that the banks won't lend against this land for any private owners. It's creating a lot of confusion, a lot of concern about the rest of the province of BC, which sits on something like 99% fee simple title on unceded territories. So my concern is that this is going to create reluctance for anyone to deploy capital to invest in this province on a significant scale. All landowners, I think, are rightfully worried about all land that they believe they own under fee simple title. Yeah, it's a bit of a mess, and it's going to be in the courts for a long, long time.
Yeah, so I think there was a judgment. So a judge did render a decision, and that's why this is hitting the news right now. But it'll definitely be appealed to a higher court. So this will go on for years, as you say, Jay. But appeals and the length of time it takes to hear an appeal, it just leaves that uncertainty out there. And I think you're right. It's if you look at the area in Richmond right now, banks won't lend. The bid-ask spread, if people are trying to sell their properties, they still want this because they think their property is worth this, but nobody's willing to sit there in there and buy it. There's going to be issues, and those issues will drag on. And I think your question there, Jay, is that going to be an isolated thing where, hey, it's just that area in Richmond?
The precedents.
Or, you've got one end of the spectrum, which is that's all it is. You've got 99% of the province, I think that was your number, that is still unceded territory. It's probably going to be somewhere in between, and there's that concern there. I think immediately, people that were looking to develop in that area, buy land in that area, I don't think they're just going to stop. They're going to, go out to Langley, go out to Aldergrove, whatever it is, and do something out there. They'll go to other areas of BC. But depending on what the outcome of the final appeal is, and depending on who the investor is, if you're an offshore investor and you've been investing in BC, you might just take that as a warning sign that, hey, BC is off the radar for now with that uncertainty. So I think it's inevitable that, this is a net negative to the economy. Development will probably slow down as lending will slow down, and that's just a negative for employment in BC.
So it's the potential of the precedent set here that's the risk here, and it's again, we're not going to get an answer within probably the next couple of weeks or months or likely years, but it's that uncertainty of setting the precedent, and what does that look like for every other piece of land out there.
Well, it becomes evident now, again, from an outsider looking in, I just take this Richmond land, 15 years ago when, say, Amazon was buying that property, or, whoever owns that property was making decisions based on investment merits, what they, saw as market multiples, et cetera. It's quite evident now you got to throw in some political and some legal risk into how you value properties, whether it's in Richmond, the Lower Mainland, or British Columbia.
Definitely something to pay attention to for all BC residents and Canadians, even at large. I mean, there's even a claim in Quebec now on a major swath of Western Quebec by another First Nations group that's going to go to court. So not a positive development for Canada's economy, and at a time when we really need some positive developments.
Well, as we talked about initially, we're going to get the federal budget this week. That'll be very interesting to see what comes out of that. That'll be Carney's first official budget announcement. We'll see what that looks like for taxation. We'll see if what was once a $45 billion deficit. There's talk that's probably going to see a 5 on it now. I think that's going to probably get a lot of attention over the next few days, and I'm sure Raymond James will be putting in a few comments as well. So that's, I think, just as topical for Canadians, what that does for families, for retirees, for small business owners, et cetera. I think it's a very important budget.
Well, I think he came out and said, hey, Canadians, prepare yourself for a lower, standard of living.
Yeah.
It's a bit of a warning sign, but I guess we'll have to see the details tomorrow.
We'll find out.
Never a dull moment. Lots going on between now and the end of the year. So we'll be back for another edition before we call it a close to 2025. See you next time.
Thanks, Jay. Thanks, Clark.
Thanks, guys.